Hey, everybody. Welcome to our Quantum Capital YouTube channel. We're so excited to put out compelling content, information for you to make decisions on investing and just kind of what's going on in the world of real estate and the economy at large. I'm joined by three of other partners on Quantum Capital: Nick Amaluxon, who is our Chief Operations Officer, Cliff Chung, who is Head of Investor Relations, and the founder and principal of Quantum Capital, Mark Henteman. Welcome, guys.
Hey.
That's all your cue to say hi or good to see you. Just
hey, everybody.
Nice to see you.
Beautiful. All right. Well, let's start on this video. We want to talk about the state of the multifamily market. And let's start with the big question that's out there right now. Are we headed for a major correction, recession, or whatever it might be? Mark, I'm going to start with you. What are your thoughts on this? Are we headed toward disaster?
Well,
take us away.
I think that we're heading into an economic deceleration, and it's driven by the Fed. So it's under control right at the moment. I mean, the Fed is driving it because they want to stop inflation. Whereas, the Fed has control of interest rates. What's not in control right now is inflation. And it's been running away due to, $3 trillion in stimulus, pent up demand. But it's not, there's factors that are still healthy. Some of the situation that we're in right now that's causing the insane inflation go back to 2008. Yeah. In the 2008 downturn, there was huge overbuilding. And, that's something that I've been through like 3 downturns. And there's these sayings that boom markets die from oversupply. And cranes in the air, buyers beware, investors beware. And I don't hear any of those today. I heard those all the time. It was like Dr. Seuss was writing the investing manuals. And those are not present right now. And part of that's because 2008, there was oversupply, overbuilding, and over leverage. Importantly, there was deregulation prior to 2008, which led to 90% LTV loans, no stated income. So you show up to apply for a loan, and you just write down a number that you say is your income, and they hand you a loan. And so it was there were like the banking deregulation that preceded 2008 caused 2008, and it caused a disaster. It was an economic disaster. But in the wake of 2008, a couple things happened, and sorry, I don't want to go on too long about this.
No, go for
it. What happened is in the wake of 2008, coming out of it, builders were so badly burned, and a lot of them went out of business, that they were slow to respond to the surging demand coming out of 2008, and that was combined with the biggest generation in history, the millennials, were all entering the household formation years, and the building did not keep up with that. And so that's why you don't hear, oh, we're flooded with oversupply right now. We're still catching up. We've been catching up. And that's driven inflation. That's why there's just not enough houses. There's not enough multifamily inventory. And I guess the last comment on that is, I think the inventory that is being built is always A class, because that's the only thing that pencils out for builders. So if there is anything's top heavy right now, it's the A class. And if we go into a recession, people are going to move down to B class. And so those are my thoughts on where we are.
I love it. Nick, speaking of millennials, let's go over to Nick and get this question out there, because what I heard Mark say makes so much sense. I think there is a supply demand imbalance that makes this particular, correction, downturn, recession unique from a real estate perspective, and specific to the sector that we invest in, value add, workforce housing, right? Mark said it. Development in A class, and really development at the low income level, right? The subsidized housing level. There's development in both those areas. There's nothing being developed, or very little, in the middle, with a heavy, heavy demand for it, right? So what people would imply from Mark's comments is, well, B and C class workforce housing then it's going to continue to go up and to the right. There won't be any cooling off. It's going to be, hot as it's always been. There's no slowing it down. Is that your take, or do you see any sort of slowing down or cooling off in the market, even in the sector, in the multifamily sector that we invest in?
No, I mean, I don't anticipate any drastic cooling off. I think when it comes to, the actual operation of multifamily, I think it depends on what you're buying. Because, while the demand might not be cooling off, you have to buy these older workforce housing assets correctly. Because you could have increasing income, but if you buy, a decrepit building with failing infrastructure, that's going to eat all your cash flow. So that's something to be concerned about. Even if rents can keep growing, but if you've got large capex expenses you weren't budgeting for correctly, it'd take a lot of rent growth to save you. I think that's probably something to be more concerned about in that asset range right now than I think drastic upheaval as far as valuations and pricing go for that B and C class segment.
Yeah, makes sense. Cliff, I'm curious for you, as you talk to investors and people that are interested in placing capital in deals like ours, or in the asset class that we invest in. What are investors concerned about? What are they saying? What have you heard from them? Are people bullish? They want to place capital, or are there reservations maybe you're hearing now that you didn't hear 6 months ago?
I would say people are very worried that things are starting to get very frothy in the multifamily space. We've seen the frothiness really bubble out from stocks, cryptocurrencies, and a lot of other markets recently. And I think a lot of people are concerned that, hey, now real estate is really the next domino to fall. Yeah. And we see it definitely in the single family market. Homes are sitting on the market longer as interest rates are rising. The concern that, that I've heard a lot is, is now really a good time to buy with interest rates rising, inflation. Is it really possible to pencil out deals and make things make sense? And my response is generally it's to have your core principles in place to make sure you understand the market. If there is a housing shortage in the market, I think no matter how the macro environment does, as long as there's multiple employers and different bases of employment, like government, education, generally you'll probably be fine.
Yeah, and that's a great point, Cliff, is it is very market specific. Like there are markets that have undersupply, and then there are markets that are oversupplied at this point. And it's Las Vegas again, I think, is leading it. Like I've seen Las Vegas in like 3 downturns. It gets crushed every time we go into recession, partially because it's an entertainment and travel destination, and that gets hit hard in recessions. And also it has endless land and it's cheap to build. But it's market specific. And I will say, all of our we're in strong markets, which the benefit is that they're very diverse economically. But Denver, Austin, not as much LA, but there's a lot of building happening there. And, we're keeping an eye on it. I think, if it's going to creep into oversupply territory.
We've invested a bunch in Denver recently, especially. We've found some good deal flow there. And Nick, I know you're right on the ground there. What is it about Denver? Cliff made a great point about diverse economy, multiple employers, all of that. In this idea of, hey, where is multifamily going? I think a point made just now is really important. The nationalizing, I guess you could say, of real estate makes no sense, right? There's markets and submarkets within submarkets. I mean, it's a very local game, real estate. So localizing this a bit, Denver, give us some of the fundamentals that you see that you're really excited about. You even sent us an article recently with some really great news about Denver. Some of the things that you see in Denver that are exciting you, or that make it that kind of market that Mark talked about, where, hey, you know what, we still see a ton of opportunity here.
I guess kind of tying in to the previous comments, because I just want to highlight one quick thing. When we're talking about housing and demand, and Cliff mentioned, seeing houses stay on the market longer. We're seeing that as well, but you have to look at what's the price point of those houses sitting on the market. That's true. Because I'm selling what would traditionally be a starter home right now in a different market, and even in with rates where they are today, it's going for 25,000 over listing with 12 offers in a week. Whereas if you're selling a $600,000, $700,000, $800,000 home, it might be sitting for a while. But also as that interest rates go up and it cuts out buyers, there's still way more people who want to buy than there is availability. And candidly, if the starter homes, which would typically go to people moving from like an apartment into a starter home, those are still very high demand and hard to get for most buyers, which are renter.
Well, and Nick, before you go to Denver, to that point, you're also seeing the fact that every interest rates make you drop your price. Yeah. So that $200,000-$300,000 home, that more starter home, has the people trying to come out of apartments, yes, but also the people that were trying to buy at $450,000 or $500,000 previously, right? So there's a ton of push into that segment. So yeah, when I talk to real estate agents, and they talk about, it's cooled down significantly. If you ask the follow-up question, they'll say exactly what you said. Well, $600K plus, that's almost ceased. But below that, $300,000, $400,000, $500,000. I mean, there's still, maybe it's not 10 offers, maybe it's 7, but there's still way more offers and way more demand than there is supply right now. And if you're sitting on a 2.95, 3.25% interest rate, you're not going to sell to then go buy a 6% interest rate. So that's going to constrain supply even more at this point, which I think we're seeing. So anyway, I'll let you continue.
Yeah. And as far as Denver as a market, that's part of the attractive thing on the multifamily side is, at least in the core areas that we focus, buying a home here, the average home price is over $600,000. Honestly, if you're being in the core areas you're going to be probably paying close to $800,000 up. So even as your income increases, that's why there's a lot of A class being built, because there's a demand for it and incomes to meet it. So the average median income in our area is very high. It's a I'd say planned city, so public transportation is well thought out. Most of these neighborhoods do a good job of, even though they're close to downtown and businesses and transit areas, they still have that kind of safe suburban walk around the streets to the park, ride your bike feel. 300 days of sunshine, which seems silly, but if you're thinking about it, when we're talking quality of life, when people can nowadays almost work from anywhere, especially in these higher paying jobs, which Denver does a good job of attracting. I think places that offer a lot of amenities like the mountains and with the weather, and we're insulated from a lot of major weather disasters, like we don't get tornadoes and earthquakes and floods and hurricanes. And then you've got the state government, right? It's the capital, obviously the city government, lots of colleges, both state and private, Denver University, pretty well known law school. You've got CU Denver, Metropolitan State University, at the Auraria campus.
There's something with Samsung recently too, right? That was announced with Denver.
A robust startup culture.
Yeah, I mean, it's also very diversified. Like there are higher paying jobs, but it's like there's aerospace and there's manufacturing. I mean, Pepsi was the biggest announcement recently, is that they're building their largest U.S. factory in Denver. You've got, obviously the government jobs, you've got the hospitality sector, you've got transportation, you've got, I mean, as far as, there is a heavy focus on, not heavy focus, but a focus on IT, tech jobs, but a lot of that comes from the colleges. You've got young people who want to live here, and the colleges are churning out, talented workforce. And so employers are coming here to take advantage of that.
Mark, just to wrap on this topic of multifamily state of the market, Cliff touched on a point about, investors asking about buying now with interest rates climbing and so on and so forth. So from Quantum's perspective, and Nick, Mark, you're both very much involved on the acquisition side. From Quantum's perspective, what's the answer to that? So we're saying essentially that, hey, we're picking great markets, submarkets within those great markets to invest in. We see the segment of the market that we invest, Class B, Class C, workforce housing, being still strong, even going into this because of supply demand issues. But a 3.2% interest rate yesterday is now a 6% interest rate today. How does Quantum buy in that environment? Or how, what are the standards or the underwriting guidelines that we're following to make sure that we can still buy in that kind of environment?
Well, it requires that the cap rates have to expand to keep the same kind of return, to get the same return. Yeah. Increased interest rates are definitely putting the brakes on transactions because it's just making everything more unaffordable. I think relatively speaking, interest rates are not that high historically. I think my first duplex was a 9% interest rate, and that was in 1999. So they were still very, very low historically, but there's the shock of what people were, the underwriting they did, what they've been used to is changing because of what interest is costing. I think the play is to go lower interest, maybe deleverage a little bit, use the interest rates. And I think a strategy is to carefully plan the step downs that you use in your debt, because you want to hold in a rate, but then you want the ability to refi out of that rate, and you want to make this economic environment work for us rather than against us. I mean, it's definitely headwinds. It's creating headwinds, but if you could navigate it properly, and it takes some guesswork, ideally you get a discount on properties now due to interest rates. And then when interest rates come down, you can then sell them at a compressed cap rate and sell them for more.
I like that. That's a good thing. That's a really good thing. I'll take that all day. All right. I think this is really a really great discussion on state of the multifamily market. Anybody have anything else they want to wrap up with?
Yeah, I was going to also add about inflation. Inflation or conversations that I've had with investors. At the same time, people are very worried about the state of the market, rising interest rates. But I think one really unique headwind here is inflation. Inflation, not only for investors, that they're worried about safely earning a yield, because a lot of them have seen some of their friends or even themselves that have earned a lot of money in the stock market in 2021. But in 2020, a lot of those gains were wiped out. So people are really trying to balance earning a yield safely while also making sure that they do have capital available for any potential opportunities. I think secondly, what's very unique about the next stage of the market that we're getting into is inflation. So in 2008, I would say there was kind of a lack of money, depending on what segment of the market in apartment buildings you were in. But now there is a lot of money out there, and people are applying in droves for very attractive apartments. For example, we just had an opening at one of our units in LA in Los Feliz, and within one day we had 7 applications. And this is like record rents. And Katy Perry actually used to live in this unit before she got famous. I was just, and I was very surprised. We keep the property very well maintained, very nice landscaping. So I think it's really, really important now to dial in systems to attract people and quality residents.
You're right. Inflation, right? There's a lot of capital out there. Having it doesn't help you much, but putting it into an asset that's going to catch the wave of inflation, that just makes sense, right? It's funny you say that. We had an apartment here where, we have an apartment building here where in Michigan, where I live, where the property manager bumped rents like to market, which was significant. We were expecting vacancy, but everyone paid. It's just they're like, yeah, it makes sense. I mean, the rent rate is going up significantly. So
we're on track for record rent growth once again, and that's why publications like Forbes and Barron's, as we enter an inflationary period, they've had cover stories that multifamily is the best inflation hedge.
Yeah, I think it is. Nick, what do you think?
I mean, I agree. If you look at, edit this out, it's not true. If you look at the CPI, if I remember correctly, the two biggest gains as far as increase were energy related gas and housing. Right. So when we're talking about record high inflation, what they're basing those numbers off of, one of the biggest contributors is housing costs.
Right.
You can talk about real estate in general, but when we talk single family, we talked into the issues we just talked about previously, which is supply. Right. So the price is getting bid up. It's hard to make those pencil on a rent basis, typically at those price ranges. and your exposure to vacancy and all that is much higher. If you're going commercial, most of those rates are, leases are structured for 3-5 years with planned increases, but you don't adjust those. Multifamily is amazing because you have 40, 100, 120 residents with 12-month leases that are expiring at different times, so you're constantly readjusting to the market, so you're kind of catching that inflation wave and not really being left behind.
That's a great point. But Mark, you're saying that there's unique forces in play this time around inflation because of what you said, supply chain. Go into that real quick.
Yeah, and I guess it's like there's been a housing shortage. We're not in an oversupply. The majority of the market is not oversupplied right now, partially due to the pandemic, slowed operations, slowed construction. And then we had supply chain issues. We had material shortages, and we've got a war. Like, there's all these things that are just piling on the unique situation that is causing a lack of inventory and driving inflation.
I don't know if I told you, this is a guy that owns, I don't know, 20,000 units or whatever, not syndicates. Albert Perez, billionaire, right? So I had the opportunity to talk to him at the beginning of COVID. And his thing, he's like, look, I've been through 5 of these going back to like 1982, right? So he's like, this is my 5th one. COVID, this is like March of 2020, like just as COVID hit. And he said, this will be the worst one, right? This is a smart guy. He knows his stuff. A year and a half later, I talked to him when it didn't end up being the worst, the worst one ever. And he said, yeah, you know what? The difference is this time compared to any other downturn we've ever had, not just 08 or 2000, where I know, Mark, you were, or 08, where I was. I think Cliff and Nick, you were alive, but maybe more college age when 08 happened. But he said, yeah, the supply demand imbalance is the absolute unique variable in this particular market or downturn or upcoming downturn or whatever. It makes everything else previously, like you think you could see within each recession and see the pattern repeating, but the supply demand imbalance is the ultimate game changer, not overall, but like in the markets that he invests in, the same markets, same asset classes that we do, right? Like value add, BC class, multifamily. Yeah.
This time around that there's undersupply, there's not that historic cranes in the air, but investors beware. It's not, we're not flooded. That has been in previous booms, but it's muted this time around because there was a pandemic. Like, right. There was no workers, there was a pandemic, there was no supplies, and we had the millennial generation, which was bringing a huge appetite to the market, but it wasn't being met. Yeah. So we don't have those problems that were very glaringly obvious in 08 and prior.
It's funny, baby boomers, then you get the Gen X, which is a smaller generation. And then in most countries, the generations continue to dwindle like numbers, but then we had the millennial boom, right? So to your point, it's not only the millennials, but the millennials are a huge population demographic, bigger than Gen Y, right?
Yeah,
so
bigger than the baby boomers.
Are they bigger than baby
boomers?
It's
the biggest ever. I think it's now the biggest generation ever.
Baby boomers got busy.
Right.
Right. They outshined their own boom.
Right.
Call us boomers. We'll make our kids the boomers. Interesting. I didn't know that.
And I was going to say another really huge factor that not a lot of people, I think that people are aware about, but no one talks about, is how much currency was printed.
Yeah, I think trillions of dollars.
I was just looking it up. 8.1 trillion.
Is it 40% of all currency ever printed happened in the last 24 months or something like that?
Yeah. And that's going to look for a place to find to call home, whether or not it's buying luxury items or investments or cryptocurrency. I think with the price of everything being very deflated, people are looking for productive assets that they can hedge with relatively low interest rates, but that will produce cash flow. So I think that's something that really makes multifamily now especially attractive because there's so much money out there.
Yeah, and what's kind of scary as just an average person in the US today is if you're not investing your money's losing like 8.5% a year due to inflation. If you're not keeping up with inflation, you're getting poorer. So if you're not investing, you gotta get your money being productive just to keep up with where you were.
And that's assuming you trust the CPI numbers. Real inflation might be higher.
Sure.
I don't know if you've heard it called the CPI or the CP lie.
Look at Cliff. That's CPA talk for CPI.
CP lie.
CP something. Good stuff, gents. This is great. I appreciate all of your perspectives on this. I know there's a lot of questions about state of multifamily, and I think the reason why this sort of content, what we're talking about, is effective is, I think you hear real estate noise, and you can get a little lost. And I'm taking from this, you can get a little lost in what real estate is. You got this national market, and a lot of the headlines are more around retail, residential real estate, like houses, right? But when you start niching it down, like we're talking about multifamily, we're talking about BC class multifamily, and we're talking about it in certain markets and within submarkets in those markets, like you talked about, Nick, in Denver, in the neighborhoods that we're in, the housing is, right? So when you get, all this noise that's out there, just remember, there's a lot of niches within real estate altogether. And yeah, that's what we think about multifamily. So thanks to all of you. Appreciate it.